Alright guys, so today let's talk about YMAX versus the world, YMAX versus SPYI versus QQQI versus everything. Personally, YMAX is my favorite YieldMax ETF, and I don't know if you guys saw, but YieldMax just tweeted this a few days ago, so this is why I wanted to cover it in the video, because this is fairly recent news and fairly recent tweet. So they basically compared themselves to the performance of QQQI and to SPYI. I don't know if they're doing that to flex or they're just showing off or whatever, but I mean, these are facts and this is true. Like, they're not allowed to tweet this if it's not true, I suppose. So essentially, YMAX has outperformed QQQI and SPYI in the last trailing 12 months as well as the last 6 months with dividends reinvested. And these are two NEOS funds. And the particularity of these two funds is that they are some community favorites. So a lot of people are swearing by these, like SPYI. They can comfortably throw their money in there, and it's basically following the S&P 500. So this is just covered call in the S&P 500. There's no NAV erosion, and the distributions have been stable. So essentially, they're paying out 1% a month. So if you put 10K in this fund, for example, 1%, you would get $100 a month in distributions, and you can drip that and compound. And you should be trailing and following the performance of the S&P 500. And this one, basically, same thing. It's basically following the Qs. So this is covered calls on the NASDAQ. And since the NASDAQ is a bit more volatile, I assume you can get more option premium with covered calls. So this one is paying around 14-15% yield. So a bit more than 1% a month. And like I said, these two are really like fan favorites or like community favorites, because they've been doing very well on like NAV erosion, capital preservation, growth, as well as paying consistent income to their investors. So people really like those, and as you can see, they even won some kind of awards that I'm not sure what it means, but like if you're in the income space, you for sure heard of these and you know they're fan favorites. And then compared to YMAX, which pays weekly, it's more volatile. It holds basically all of the single stock ETFs from YieldMax, which are known for paying high distributions, being volatile, and have a bad reputation with all the NAV erosion stuff. And now they come and they shoot this bullet saying like, look at us, you talk crap about your NAV erosion, and now we're outperforming all of these other ones. Like, what are you gonna do now, you know? And I think the reason why they've been doing a lot better is because last year in September they switched to weekly distributions, and since then the NAV has been much more stable. The compounding has been greater because now every single week people are able to drip their shares and increase their income, and they're able to buy back in the market, buy more shares every month, every week, regardless of the market conditions. So this really helps keeping their average as low as possible. And this really helps with the total performance of YMAX. And they also made some changes to their strategies, and now I think they're more protective and they're less they're more protective towards the downside. So this allows YMAX to avoid big drops in the NAV, and I think they're also capturing more upside as well using their new option strategies. So today I wanted to talk about that, and as you can see, there's another guy here on Twitter that said that he got this email from Bloomberg, and people think it's obviously like advertisement for YMAX, but at the same time it is facts. And these are basically the same numbers that YMAX tweeted. So I think it's very cool to see, but I wanted to dive into the numbers and actually look at what a portfolio would have looked like if you would have invested $10,000 in all of these funds. What would actually be the performance? Like, it's cool to see total returns, but I mean, recently in April we had a big crash, and like at the end of the day, yes, you're up and everything, but when the market is crashing, is your portfolio super volatile and losing all of its value? And then like some people are not able to handle that type of risk, and YMAX isn't necessarily the best position for everyone. This is why I think that even though YMAX is my favorite ETF from YieldMax, and my favorite covered call ETF as well, I think that some people shouldn't buy YMAX because it's a lot more risky and volatile than SPYI. SPYI, you can really just dump your money, and it follows the S&P, where YMAX also follows the market, but when the market crashes, it pulls back harder, and when the market has a bull run, YMAX pulls up harder as well. So it's just more returns equals more risk, less returns equal less risk. So it really depends on the investor profile. All right, before I get into the actual numbers and how these funds would perform in a portfolio, I just wanted to say, like I usually do, thank you to everyone subscribing, everyone commenting, everyone throwing me some ideas, and everyone also sharing. Like, there's some people in the comments that make so much passive income. They have, I don't know how many shares of Misty and Ulti, and they make like multiple 4 figures a week, multiple like 5 figure a month from their portfolios. And it's crazy that like we're building a community of income investors, from beginners to people who have so much money, skin in the game and money invested. So like, thank you so much for everyone subscribing, liking my videos, commenting. Let me know in the comments if you guys have any ideas for future videos. Like, I take notes of these and I will make those videos and shout you out. I just really wanted to say thank you. Thanks guys, and let's get in the video. All right, so I really like this tool that I use. It's called portfoliovisualizer.com. You guys should try it out if you want to backtest some portfolio. So this is backtesting and it's not forecasting. I made basically 3 portfolios. One portfolio SPYI, one is QQQI, and one is YMAX. The 3 of them 100% SPYI, 100% QQQI, and portfolio 3 is going to be 100% YMAX. And then it's going to start from September, where YMAX switched to weekly, up until the latest month, which is July. And I put $10,000 in with no cash flow, and reinvesting of dividends obviously has to be on. So now if I do analyze portfolio, it's going to give me the returns of the 3 portfolios. So SPYI would have given you a total return of 8%, which is very good, and a standard deviation of 10 and a drawdown of 5. And then as you can see, QQI is a bit more risky, a bit more volatile, but you have you went from 8% to 14%, so your total return is 6% higher, and then YieldMax, a total return of 15%. So this is where you see that this here is true. But the thing I wanted to show you guys is you have to look at the standard deviation in the drawdown here. The more volatile and risky you are, the more total return you are expected to make as well. So the thing is, yes, it's cool. YMAX total return is fun. Like, you make much more money with YMAX. Does that mean that SPYI is bad and you have to sell all of your SPYI? Not necessarily, because with SPYI, your mind, you can take your mind off the market, and your portfolio is not going to be as volatile during like some bad events, like when Trump was doing all of the trade war and the market basically crashed in April. As you can see, this takes into consideration the April crash, because it's in the last year. SPYI had a maximum drawdown of 5%, which is still a lot. Like, it's still a lot for your portfolio to drive up 5%, but this is expected when you invest in the stock market. A QQQI portfolio would have seen a drop of 8%, and a full-on YMAX portfolio would have seen a drop of 12.5%. So this is a lot, guys. If you have like $200,000 invested in the market, you would have seen a drop of $24,000, versus someone holding SPYI, he would probably be a lot less stressed. He would have seen a drop of around $10,000. So, I mean, this is the numbers that they're not going to show you. Is, yes, the total returns are higher, but you have to see the risk of that ETF, and you have to see the portfolio is high and the portfolio is low, and see if that fits for you. Are you comfortable with a 12% drawdown if the things go bad? Like, are you comfortable with that? Because at the end of the day, if you're investing in the long run, you know that when the market crashes, it's a perfect time to buy, because the shares are going to be on a discount essentially, and that's where you can grab the most shares possible. So if you know that, you're good. But a lot of people, when the market crashes, they start stressing out. Like, a lot of my friends, when the market was down in April, some of them were like, damn, I don't know what to do. Like, I have so much cash. I don't want to put my money in the market. Like, it's going to keep crashing. And I was just like, bro, like, I don't care. Whatever's happening, I'm just investing every single month. I pick one day a month where I drop my recurring investments, and I don't care, and it paid off. And all of the shares that I was able to grab when the market was dropping, right now they're all up, in my portfolios at all-time high. When people that were sitting in the sidelines, their portfolio has recovered, but their portfolios are just back to what it was before, where if they would have bought shares when the market was down, they would have made so much more money. So it really depends on your investor profile, guys. And I really wanted to, like, the return is very important, but the maximum drawdown is something you guys have to look at. Now let's just change the data a bit, because this makes a difference, guys. And this is why I think everyone should invest on like fixed. Everyone should contribute to their portfolio on a recurring basis. So let's say you have 10K invested, and then every month you invest $500, because regardless of the market condition, when the shares are high or when the shares are low, you're going to be buying back more shares, and it's going to really affect your portfolio's returns. So as you can see, if you put $10,000 in the market, $10,000, and then you add $500 a month, your total return for SPYI would be actually 60%. Your total returns for QQQI would be 68%, and your total returns for YMAX would be 69%. So excluding the cash flow, it's the same. But now, since you're buying shares even when the market is down, the actual maximum drawdown of your portfolio, your portfolio's shares, your portfolio's distribution, plus the cash that you add yourself to your portfolio, for SPYI, it goes from minus 5.5 to minus 0.8. So you would have seen almost no drawdown during the market crash if you would add your own money to your portfolio. And then for QQQI, you'd be minus 3, and for YMAX, minus 5.5. So this is why personally I invest heavily in YMAX, is because my investing style is I do not lump sum. I do lump sum at some point, but I do force myself, and I make sure that every single month I invest whatever I can, regardless of if it's a lot or if it's less, depending on my expenses and whatever happens in life. Like sometimes you can invest as much, but I make sure that every month I have a bit of cash left over that I can invest in the market. And this is exactly why, is because if you invest every single month, on the months when the market is not doing well, you're going to be kind of timing the market in a good way, where you're going to be buying shares when the market is low. And the fact that you're adding cash, some brand new cash to your portfolio, you're going to bring up the value of your portfolio. So you're not going to be as affected by the market crash as someone who's just letting his portfolio ride the market and just invest here and there and not add his own money to his portfolio. So it's important to contribute a fixed amount every single month. As you can see, it really helps with the volatility of your portfolio. All right. So now one cool thing, what I did is I compared the total returns of YMAX and the Qs, because I think YMAX is probably closer to the Qs than to the S&P 500, because YMAX right now has about 35 to 40 holdings, and they're kind of like hot stocks with high volatility. That's why they do covered calls ETFs on them. And as YMAX adds more holdings, they're probably going to get closer to the Qs, maybe even closer to the S&P. So as you can see, YMAX is actually outperforming the Qs, but you can see that the movement of YMAX, like when there's a bull run, YMAX really pushes hard and separates itself, and same thing here. But I just wanted to show this chart just to show that YMAX and the Qs are kind of following the same movements pattern. They don't have the same returns, but when the Q go up, YMAX goes up and down and up at the same time. All that to show that what you could do that would be cool is maybe hedge your YMAX if you want to de-risk. So YieldMax offers YQQQ, which is an invert of the NASDAQ with income. So let's see what that could do. So that could actually be cool. Obviously, if you hedge your YMAX, you're going to have less risk. Like I said in the video, less risk equals less reward. So you're going to affect your total returns, but you're also going to affect positively the volatility of your portfolio. So if you're someone who likes YMAX and maybe is not comfortable with the risk associated with YMAX, but you still want to buy some YMAX, this is something interesting that you can try. So now the YQQQ is here. If you make your YMAX portfolio 80% of YMAX with 20% of YQQQ, so for every $100 of YMAX that you buy 20% of YQQQ. So every time you buy $100, you also have to buy $20 of YQQQ essentially. That's how it would work. So yeah, this would be my portfolio, and then I would call it YMAX de-risked. YMAX de-risked, okay, 80%, 20%, perfect. And then you contribute $500 a month, same thing. All right, now let's look. All right, as you can see now, your standard deviation dropped to 14%, which is almost equal to the same as QQQI, and your drawdown is actually lower than QQQI, and basically up to par with the SPYI, and your total return is essentially a bit higher than SPYI, but now you've made less money than QQQI. So like that's the thing. When you hedge, when you de-risk, everything that is low there, like if there would be something low risk that pays a lot, everyone would throw all their money in there. So that doesn't exist. So if you want to make money, you have to take risk, but there's always some ways to kind of de-risk, and everyone should kind of de-risk to what they're comfortable with. And here, as you can see, the max drawdown excluding the cash flow. Now if you just add 20% of YQQQ in your portfolio, you're going to see a max drawdown that is basically up to par with the QQQI. So instead of being -12, you're going to see a drop of -8, which you're saving yourself 4% in a very bad market situation, which I think could be cool for people who have less of a high risk tolerance. And now maximum drawdown, including cash flow, now it's pretty cool because your YMAX portfolio had a maximum drawdown that is almost the same as SPYI, and you have a actual less minus drawdown than QQQI. So the de-risked version of YMAX, if you add a hedge, could be very interesting if you're someone that has less of a high risk tolerance. And as you can see, you outperform SPYI. So you can basically have SPYI's risk with some weekly distributions, but this is not equal. I'm not saying this is like investing in SPYI, but for someone who really wants weekly distributions but doesn't want the risk of YMAX, this is an option that you can go with, and the total returns would be 61%. And QQI here would have outperformed because you're not hedging it, so you're taking the full risk. And this is the chart. So these are very, very close at the end of the day, and they're three very, very good ETFs. It just really depends on what you're looking for as an investor, what's your risk tolerance and everything. And like I said, like you can play around, guys. Play around with this tool, see what works for you, look at different time frames, and try hedging, try not hedging, try hedging QQQI with YQQQ, try hedging SPYI with an inverse of the SPY maybe. And it's always good to be prepared for the worst conditions, and having a bit of hedge in your portfolio, not necessarily being 50-50, but just having a 20% of hedging in your portfolio could really save your sanity. And especially me, like during the bear market, all of my friends were stressing out and everything, and it was making me stress too, even though I knew that all I had to do was keep buying, and I did it, but it was kind of stressing me. And now going back, if you would have had some hedging in your portfolio during the April crash, maybe it would have kept your sanity, or you wouldn't be stressing as much, because every time a headline drop and the market goes down 2%, well, you have your other position going up 2% and whatnot. So yeah, guys, hopefully this was interesting. I think it's pretty cool to see that YMAX has been outperforming those two very popular ETFs. But I just wanted to make it I just wanted to bring my own take on this and show you guys that total performance isn't always as cool as it looks. It also means that your portfolio is more volatile. So just be careful of these kind of metrics, guys. YMAX is a very good ETF, obviously, but it comes with more risk. So you have to be comfortable, and you have to know that when you buy YMAX, you're also buying into risk. So yeah, hopefully that was interesting, guys. And until next time, if you watch the whole video and you're still here, thank you so much. Let me know in the comments what you guys think, whatever, any suggestions for future videos. Until next time, take care, guys.